Hey everyone, this is Dan. In this video, I will tell you why I believe there will be a market crash within 6 months from today. I will share with you what the experts have been saying, and I will show you some of the early signs of a crash. First of all, the market is very high now. Stocks from many companies are so high now, there's no way to justify what the investors have been paying. Nikola, the electric vehicle company, is one such example. They have showcased a few impressive looking prototypes vehicles to the world. Being a startup company, they have not been making any profit in the last 2-3 years. But back in April of this year, the stock of Nikola was trading at about $12 a share. The company was worth about $4 billion, which is pretty good for a company that had not generated any income yet and was losing about $10 to $20 million a quarter because of the startup activities. To be fair to Nikola, I have to say that it is typical for a startup company to go through the first few years without generating profit. On June 4th of this year, Nikola's stock got listed on NASDAQ. See what happened to the price. At its peak, the stock was at $93.99. That means the company was worth now $35 billion from $4 billion. Then the investors decided that the company was probably overpriced. See what happened next. The company now is worth only $7.9 billion from $35 billion. That's still a lot of money for a company that has not been making any profit. I'm not trying to make fun of Nikola. Actually, I hope they will become successful one day and start making profit. The story of Nikola is a cautionary tale for us to make sure we don't buy a stock when it's up here and find out a few months later we are down here. Inovio, a pharmaceutical company, is another example. Inovio has not made any profit up until now. Then it started to develop a COVID vaccine. When the word got out earlier this year that Inovio was developing a COVID vaccine, its stock price went up 80% in just 8 months. Then it dropped more than 50% in 3 months. There are dozens, if not hundreds of companies that are like Nikola and Inovio. People have been buying stocks at unreasonably high prices. If you see more price movement like these, going up and then dropping down quickly, the domino effect can start to happen, and that's called a crash. Another example of the market being too high is when a fairly successful company announces a stock split. A stock split does not generate any additional fundamental value to the shareholders. Yet, this was what happened to Tesla after they announced their stock split. They announced a stock split on August 11th, 2020. The stock price jumped up. And then the stock price came down a little bit in the last few weeks. This is what happened to Apple Computer after they announced their stock split on July 30th. Price jumped up, then it came down again. There's an academic term to describe this type of investor behavior. It's called irrational exuberance, which is a polite way of saying the investors have gone crazy. I'm not the only person who says, hey, something is wrong here. Actually, many famous people with a lot of investment experiences are saying the same thing. The famous people who are saying the market might be crashing include Robert Kiyosaki, the author of the best-selling book Rich Dad, Poor Dad; Ray Dalio, the billionaire hedge fund manager; David Einhorn, another billionaire hedge fund manager. Then there's a famous Nobel Prize-winning economic professor, Robert Shiller, who actually wrote the book entitled Irrational Exuberance. Below this video, I provided the links to the video on what these famous people have said about the market. If you're not convinced yet, I will show you a few charts. There are several economic indicators that are screaming at us, absolutely screaming at us, saying that a market crash is coming. Let's look at these indicators. This is the chart developed by Professor Robert Shiller. It's called a Shiller P ratio. With this chart, the higher the number, the worse the condition. Professor Shiller used this indicator to correctly predict the 2000 market crash. Then again, he correctly predicted the 2007 market crash. As you can see from this chart, the current state is as bad as 1929, right before the Great Depression. It is definitely worse than 2007, which is here, and worse than most other crashes, with the only exception of the 2000 dot-com crash. Let me show you another chart. This is the Crash Confidence Index. It's also developed by Robert Shiller. The way it works is that the lower the measurement, the worse the condition. And this chart is saying that we are in the worst condition since the measurement started in 1994. Here's another chart, the Buffett Indicator. This is the indicator used by the famous investor Warren Buffett to look at investment opportunities. According to this chart, today is the worst time for making investments because the Buffett Indicator is at the highest point ever since 1950. It is definitely worse than even before the 2000 dot-com bubble crash, and definitely worse than before the 2007 crash. And that's why Warren Buffett has been holding a lot of cash lately instead of buying a lot of companies. For those of you who like to look at formulas, I've included below this video the links to a few articles that explain how these indicators are calculated. This is a chart that I developed myself to show whether we are going to have a market crash or not. If you imagine a market crash is like an earthquake, before a big earthquake, there are usually some little quakes. And before we have a major market crash, we usually have market dips. If you look at the year 2000 and the 2 years before that, we see these dips leading to the crash that started in September of 2000. Then we look at the years from 2005 to 2007, we see a few dips before the crash that happened in October 2007. These dips show the investors were starting to lose confidence in the stock market. Now, when you look at from 2018 to today, we see these two major dips, which were much worse than the dips before the crash of 2000 and before the crash of 2007. What this is telling me is that today there's a lot of anxiety or fear among the investors. With so much fear in the community, any additional problem could easily trigger a major crash. Now, you might say that the worst already happened between February and March of this year, right here. The market did go down for more than 30%. Then it recovered because the Federal Reserve Bank bailed us out and we had a $2 trillion stimulus package. And you might say, hey, what didn't kill us makes us stronger. Are we really stronger now than we were back in February and March of this year? Let's do a comparison. Here's a table. On the left side is a list of things that we saw back in February or March of 2020. On the right side is what we have now. Back then, COVID was just starting. Now we have many more confirmed cases. And COVID cases have been surging again in the last few weeks. Unfortunately, hundreds of people in the US are still dying of the disease every day. Back then, we had no effective COVID vaccine. Fortunately, we now have more effective treatment protocols. But as I mentioned, hundreds of people are still dying every day. Back then, we had no vaccine, but now we are hopeful that a vaccine will be available within 2 to 3 months, or maybe more than one vaccine. Back then, we did not have any shutdowns. Now, many businesses and schools already went into shutdown between April and September. And still, even now, many businesses are still under restrictions. Back then, it was business as usual. Now we see a lot of bankruptcies in the retail and restaurant businesses. Back then, the mortgage forbearance rate was around 2%. That means when the mortgage goes bad and the holder either doesn't pay the mortgage or is late paying the mortgage. And now that rate is high at 6.8%. Back in March, we had a $2 trillion stimulus package. Now we still need a stimulus package, but we don't have one yet. Back then, President Trump was in office. Now, Washington, D.C. might go into lame duck mode until the new president is inaugurated at the end of January, so nothing might happen until February. Back in March and June, the Federal Reserve Bank spent $3 trillion buying assets to shore up the economy, to shore up the market. The Fed has not been buying much assets since June. The good news is that they did promise that they will, quote, do whatever it takes, unquote, to support the economy. The real danger, I believe, is the continuation of these negative factors while Washington, D.C. goes into lame duck mode. The market can possibly go into a free fall in the next few months. Although the Fed might come to our rescue if the market drops by more than 15 to 20%, like what happened back in March, but then it might be too late. Overall, I think a drop of 25 to 30% is very possible in the next 6 months. If you believe what I'm saying, you might ask, how do I survive a market crash? That's a great question. I will send out a video in the next few days on this very important topic, how to survive a market crash. This concludes my video for now. If you have a few more seconds, hang in there. I have some reference information I'd like to share with you. In the meanwhile, thank you for listening. I wish you best of luck with your investments. The following is a list of the analytical tools I use and the information I look at every day to develop my investment strategies. After doing hours of research, I summarize my findings into just a few minutes of video for you. Links are provided below this video for you to learn more about RSI, Bollinger Bands, the role of the Federal Reserve Bank, etc.